It is a real pleasure for me to be with you here to explain our modeling experience after the Kahramanmaraş earthquakes or the Kahramanmaraş earthquake sequence. All right, so a brief introduction. So I'm the head modeler of a newly established company, T-Rupt Technology, which is actually 100% subsidiary of Türk Reinsurance. And Türk Reinsurance is actually technical operator of TCIP. So in that sense, we are responsible of the CAT modeling of TCIP assets, as well as the portfolio of Türk Reinsurance for her reinsurance modeling. All right. So what I'm going to explain today is, without going into the details, technical details of the work we conducted, because I know that this is already a late afternoon session, and I know most of you are not very much familiar with the whole thing. I'm not going to be a boring person presenting you the details, but I'll walk you through the modeling steps of TCIP losses right after the Kahramanmaraş earthquake. So the contributors of this modeling is given in the secondary heading of the presentation title. All right. So the outline of the presentation. First, I'm going to give you an overview of Kahramanmaraş earthquakes. Then I'm going to talk about the main loss modeling components explored for TCIP insured portfolio losses. And then after that, I'm going to explain our case studies, sensitivities, and observations from these sensitivity analyses. And right after that, our estimates of losses for the TCIP portfolio affected by the earthquakes. What is the reason of that? Let me just, before going through the reason, because right after the earthquakes, the head of the company, Türk Reinsurance, wanted to know the cash flow. It was a big earthquake or sequence of earthquakes, and she wanted to know what level of cash flow the company would need to start answering or recompensating for the claims. All right, so this is actually one of the main reasons of, say, starting this work. And before that, again, going through the details of this presentation, actually, I have been working in the academia for about 25 years, but then right after, say, for the last 3 years, I started working on this CAT software, which we call it as CAT mode, and it was actually a very good sort of stress test for CAT mode to see how it is running under this type of serious events. All right, so this slide here gives an overview of the Kahramanmaraş earthquakes, and I'll just try to show you through the aftershock sequence here. I'm just heading the laser pointer to the screen right in front of me. All right, so the traces of aftershocks here clearly show the ruptured segments after the Kahramanmaraş earthquakes. So this branch here is ruptured right after the first major shock, which is about 7.8 in magnitude scale. And this is the second ruptured segment right after 9 hours difference from the first event. So with a magnitude of 7.6, again in magnitude scale. Now, the length of this rupture, the first one, is around 300 kilometers, whereas the length of the second rupture is around 150 kilometers. As a matter of fact, this region has been silent in terms of big events, large earthquakes, for about 500 years. This is typical for Eastern Anatolian Fault. For large events, it is quite silent, but right after that, you would see very big earthquakes like this one. So for at least 500 years, the southeast and southwest part of Eastern Anatolian Fault has been silent. Okay, one of the first questions raised right after the these earthquakes was that whether these two events are dependent on each other or independent of each other. This was important for the insurance sector because there are different provisions in terms of payment depending on whether these events are dependent events or independent events. And essentially, this was the first challenge we faced, and we started working, collaborating with seismologists in that sense to answer the question if the second one is a triggered event by the first one or not. So what I'm showing here is that the stress distribution of the first event right after the second, right after it is ruptured. So the reddish line here, or color here, indicates the stress surcharge or the stress concentration. And as you see here, so this is the first ruptured, say, these are the segments ruptured after the first event. So as you see here, there is this reddish color surcharging towards the second segment. And based on the interpretations of the seismologists, this extra surcharge of stress to the second segment here caused the second event, second large event, all right? So essentially, the first event triggered the second event because of this excessive, say, stress. So this is, once this was sort of sorted out, once this was proven scientifically, we started working on the seismological features of these events because essentially it was, I mean, knowing the seismological features or specific features of these events would help you modeling it as reliable as possible. And essentially, we have seen that, all right, let me see, where is it? All right. So we have seen essentially that there is one specific feature of these events that, which we call it as forward directivity effect. In terms of forward directivity, so this is what it is. So when the rupture propagation of the waves, when the wave propagation and the rupture is in the same direction, then the amplitudes of the ground motions increase significantly, which is called as forward directivity. And now this is the fault segment we modeled for the first event, and the reddish color here indicates the zones or regions. So this is actually the Antakya or the province of Hatay, where there's significant damage and significant number of casualties. You see, this region is affected by the forward directivity effects, which is one of the reasons why we experience significantly large damage as well as fatalities within this region. And another point that increased, the fact that increased the number of fatalities and increased damage is that the city of Antakya, Antioch, is actually on a basin, and basin effect also amplifies the seismic waves, which is another reason for experiencing or having that kind of large structural damage. The right panel here shows the forward directivity regions after the second event towards Malatya, the city of or province of Malatya, where you have lots of industry and where you have seen lots of residential damage as well. Now, this segment and this segment is what we modeled to start populating the ground motion fields, because for these two earthquakes, because essentially what you are doing is you are populating or sampling ground motions. You are simulating the ground motions of these two events. And then after that, you are exciting the portfolio. You are disturbing the portfolio with those simulated ground motions, and then start calculating the losses, the portfolio losses. That's what you are doing essentially, all right? But while performing these runs, because you have different sorts of challenges, for a complete, before completing your CAT model, loss model, you have to look at several parameters that would affect your losses, loss estimations. So what these parameters are: the uncertainty in the vulnerability model. The vulnerability model is actually the basic relationship which relates the ground motion amplitudes with the loss, all right? And then the soil conditions at the site of interest. If you know the soil conditions at the site of interest, then essentially you will be able to generate, sample more realistic ground motions, ground motion fields. And then if you are really dealing with a large portfolio like the one TCIP has, then you have to understand the granularity or uncertainty in the spatial distribution of the portfolio, because most of the time when they hand you over the portfolio is lumped most of the time at the sub-province centers, all right? I mean, this is the fact. The treaty portfolios, most of the time, if you are dealing with residential buildings, they are lumped at sub-center, at the centers of the sub-provinces. So then you have to see if these are making some sort of difference in your calculations against, for example, when you have a portfolio distributed all over the geographic region that you are sort of dealing with. And then the other point is that the portfolio granularity. Again, if you are dealing with large numbers of policies, risks, then essentially you may not have a good physical definition of your portfolio, like the number of stories or the height of the buildings, the year built, the buildings, you don't know too much of the year built, and also the type of construction, if it is reinforced concrete or steel or masonry or what's adobe or that kind of stuff. So then for a better understanding of all these uncertainties, you have to start running lots of different analyses, all right, sensitivity analysis. So that's what we did before completing our loss model, or loss model. Okay, so site conditions in earthquake engineering basically described by a parameter which we call it as VS30. VS30 is actually the average shear wave velocity of the soil at the first 30 meters beneath the, say, free surface. So if you have VS30 values like low enough, it means it's a soft soil condition. If they are high, then it's a rock condition and so forth. So we looked at the uncertainty in VS30. Then spatial distribution of portfolio. Again, as I told you, portfolios, treaty portfolios in particular, they are most of the time lumped at the district centers or sub-province centers. Then you may also have portfolios distributed at different, say, degree within the geography you are working on. And then the vulnerability models, you may have a full range of uncertainty and vulnerability, or you may face with mean vulnerability models. And then the granularity of the portfolio, you may have a very good, say, physical attributes in your portfolio, like the age of the buildings, like the height of the buildings and everything, or it's essentially you may only have some of that information at the end. And then the other challenging point for this specific case, the Kahramanmaraş earthquakes, is that within 9 hours of difference, we faced 2 earthquakes. So essentially, when you run your analysis, you have to consider the effects, the sequential effects of these 2 earthquakes on the estimated loss. So this is another challenging thing. So this is like really what happens about the uncertainty or the knowledge about the site conditions. So say that you have a fine, say, grid cells with, say, a point of 25 degrees each. So this is sort of the distribution you will be dealing with in your analyses with a very well, say, differences in site conditions. And if you are only having information of site conditions at the centers of the sub-provinces, like this case here, you will assume that the whole province is represented by a single site condition. For example, you would end up with like really the whole province is rock, or the whole province or the whole sub-province is soft soil, because this is what you have essentially in your hands. It all depends on the level of information you have in your portfolio, all right? If the whole thing, if the buildings are lumped at the sub-centers of the provinces, then essentially you will only have information on site conditions in terms of that sub-province center. That's it. So so that's one thing. And the other thing is that the portfolio distribution. Now, the one marginal case is that, again, portfolios lumped at the sub-province centers. So you say everything is lumped at the sub-center, the center of the sub-province. Or you may have, as in this case, a portfolio distribution in the region where the in spatial distribution distributed within the region of study, as you see here. All right. So between these 2 marginal cases, your loss analysis would make a difference essentially. Okay. So again, this is the vulnerability models we are using. This is a typical vulnerability model. So as I indicated, the vulnerability models essentially relate the ground motion intensity, which we use peak ground velocity in our cases, with the damage, all right? So you may have a single curve, which is called as mean curve, relating the damage caused by different peak ground velocity values, or you may have a distribution of vulnerability, which accounts for, which accounts for the uncertainty in the estimated damage or predicted damage due to a given peak run velocity value. So again, this makes a huge difference in terms of your loss analysis. The other point is the granularity of the portfolio. So you may have a very good, portfolio with all physical attributes like the year build, the height variation and everything, or you may have only a single information, which is I sold building, residential building policy. So that's it. So if you have a good portfolio granularity, then you will be able to take account for the uncertainty in the damage of that portfolio through some very good, say, vulnerability model. Or if you just know that the residential building is essentially a building, then it's going to be only a single line. This is something that you are seeing in real life. I mean, sometimes you have such kind of policies. You just say, you get something from the agency, insurance agencies, and saying that this is a residential building portfolio. That's it. Nothing else. No year built, no building height, no nothing. All right. And the other is, again, the other challenge is that essentially the way how you approach to account for the sequential effect of these two, earthquakes on the damage, all right? So if it is only the first earthquake, this is going to be the vulnerability model you will be using. But then because there is the second event, you have to modify your vulnerability model. And what we did in that case is that we modeled the original vulnerability model of each asset by using a functional form, different functional forms, with some assumptions of overall portfolio behavior, conditioned on the damage from the first earthquake, all right? So this is sort of trying to estimate, trying to predict the loss, accumulated loss, right after the two events. Now, with those uncertainties, the first thing we did was to see which parameter of these really affect your loss estimations, depending on the, say, portfolio granularity you have. I mean, I'm going to make it short because these are all details. So we did, in principle, two, say, major sensitivity analysis. In the first analysis, we assumed that the base cases for normalizing the whole, results, the portfolio granularity is as is, which means with well distribution and everything, but portfolio spatial distribution is lumped at the sub-province centers. Vulnerability, we considered only the mean vulnerability, and VS30, we considered the mean VS30 without considering anything about the uncertainty of site conditions. And then we did several trials from case 1 to case 6, starting from portfolio granularity as is, but then turning on and off each one of these parameters. For the first case, we turned on the uncertainty in site conditions. For the second case, and then shut the rest. For the second case, we turned on the vulnerability uncertainty. And in the third case, we turned on the special correlation, the special variation of the portfolio. And for cases 4, 5, and 6, we started playing with the granularity of the building portfolio. So as for the fourth case, we disregard building height variation. For the fifth case, disregard yield build. And in the sixth case, the most simplest one, disregard both building height and year build. And essentially, what we did, we estimated the loss distributions for each one of these cases, and then compared the loss distributions of each one of these cases with the base case. And what we see is that for the first three cases, the mean vulnerability estimate, sorry, the mean loss estimation is insensitive of the, say, deficiencies in your vulnerability, site condition, and spatial distribution of the portfolio. And for the rest of the three cases, cases 4, 5, and 6, depending on the, say, level of granularity in your portfolio, the portfolio behavior for each event, this is the first event, this is the second event, changed significantly. We did the same case, but this time we started from the opposite. We used base case as the most complicated one, and then we turned on and off each parameter, each, say, parameter we sought for its sensitivity from case 1 to case 6, the same things. And essentially, we observed the same thing. And from these two major sensitivity analyses, what we have observed was, if there is a well-defined portfolio granularity, if everything is well-defined in terms of physical attributes, then there is insignificant variation in median losses, in mean losses, due to uncertainties in site condition, vulnerability, as well as the spatial distribution of the portfolio. This was our first, say, observation. Second observation, the dispersion about median losses are sensitive to the uncertainties in site condition, in vulnerability model, as well as the spatial distribution to portfolio. Essentially, what I'm saying is, in terms of mean or average loss estimation, there is no too much of sensitivity for VS30 or site condition or vulnerability or the spatial distribution of the portfolio. But the dispersion about mean is very sensitive. That's what I'm trying to say. And essentially, in CAT modeling, what you are trying to come up with is the loss distribution. This is quite important. If you have a loss distribution with minimum dispersion, then your estimations are more reliable and justifiable. If the dispersion about the mean is significant, then you may have some reservations about your estimations of loss. For the third conclusion we draw from these sensitivity analysis is that there is an intricate interaction, complicated interaction between loss and uncertainty in site conditions, vulnerability, the damage model. And this is, this is understandable, this intricate relationship, because essentially the site conditions affects your ground motion distribution, the ground motion amplitudes you are coming up with, and then this distribution eventually affects the loss. Because again, the idea is quite simple. You have ground motions, you have portfolio, you just perturbate your portfolio with those ground motions. And if the ground motions are uncertain, with lots of uncertainty, then your loss is going to be with lots of uncertainty. So this is sort of following a logical sequence. The challenge in loss modeling is that you have to quantify this. You have to quantify. And that's for the fourth, I say, conclusion we draw is that underreported portfolio granularity. By saying underreported portfolio granularity, let's consider the two marginal cases. One is very well-defined portfolio with everything, with all physical attributes you have. And the other is just you said you know that it's a building, that's it, nothing else. So underreported portfolio really makes a huge difference in terms of the overall loss in the portfolio loss estimation. I mean, the distribution shifts from one side to the other side, as I try to show it here. So the distribution shifts from one side to the other, depending on the level of information on your portfolio. Now, I mean, I know that I'm taking too long, but I apologize. I try to make it as simple as possible. This was like really a challenge in terms of modeling. So as I indicated, one of the most important, say, challenges we faced during these events is that within 9 hours of difference, we had two very big earthquakes, and the portfolios, the insured portfolios, got affected from these two big events. And then you have to make a good sort of physically justifiable modeling to consider the sequential loss from these two events. So essentially what we did is that we tried to estimate the damage right after the second earthquake by considering the already occurred damage after the first event. So essentially we tried, so again, in that sense, we modified our original vulnerability model with some modifying functions, indicating that the overall portfolio is well defined or is well behaved under the earthquake action, or the overall portfolio, the opposite side, the overall portfolio behaved very bad under the earthquake action. Because we don't know which one it is true, and there are several intermediate ones in between those two marginal cases. I mean, we were not at the site. We didn't know how the things happened there. The information coming to us, it was quite fresh. We didn't know anything about the real extent of the damage and so forth, but we had to make an assumption. And what we see is, again, from the sensitivity analysis, that depending on the type of assumption you make on the portfolio behavior, the loss distribution, again, is significant. Then we came up with a simple methodology to make a reliable estimation on the, say, damage after these two events. So for the first step, we collect damage states of building portfolio from public open databases. And in that case, our database was the database of ministry. The ministry started reporting damage right after these events regularly, and then, but with in a very coarse way. And then we used that information to sort of calculate a reference index. And then as for the second step, we perform loss analysis with alternative modifying models for each one of those, and then try to approach that reference damage index as much as possible, because this is the only information from the field. The loss reported by the ministry from the field, and the damage index we calculated from that observed coarse data. That's the only information we had. We were not able to go and look at the buildings and anything. So then, essentially, after those different trials, we picked the modifying model from one of these, the modifying model which approximated that reference index we calculated from step one. And this is actually the whole story. So I'm showing you the case for Kahramanmaraş province. Essentially, these are the damages reported by the ministry. These are the reference damage indices we calculated for each sub-province. And these are the samples from several trials of each one of these modifying, say, functions. And essentially, this is the trends we got from these, say, modifying from error analysis. And essentially, this is the modifying function we picked in our loss estimations. And this is actually what we handed over to the management of Türk Reinsurance, the technical operator of TCIP, within 20-25 days. The blue lines, the blue vertical bars here indicate our estimations, and the orange ones indicate the paid loss as of June 7th. So the head of the company wanted to know, on average, the level of losses that she would be facing to encounter the necessary cash flow. And within 20-25 days, our mean estimates are around 25.3 billion Turkish lira. So Menekşe has already indicated that this is around 1 billion, the current paid. And then as of that day, as of 7th of June, the TCIP at that time had already paid 26.3 billion. So with the standard deviations I'm reporting here, our estimations are in good order with the field data. Of course, there are cases like the Hatay case here, where our loss estimations are significantly below the already paid one. This is because, for example, in the case of Hatay, right after the 20th or 25th day, there was a very large aftershock. It struck the whole city once again with the region. It was 6.4 magnitude, and it caused a significant damage right after we finished these estimations, and we didn't go back, return back to our calculations and to modify our calculations. It was useless because we already had reported our estimations. And those things, for example, caused some offs here. But at the end, for the entire region is around, say, half of the eastern part of southeast part of Turkey. The overall estimations, I believe, is success for a CAT model. All right. So my apologies for taking it long. I wanted to make it as clear as possible, the whole steps with clarity, what we did for estimating the TCIP loss after these earthquakes.